Capital gains tax can significantly impact a landlord's profits when selling a rental property. Understanding this tax is crucial for property investors looking to optimise their returns and stay compliant with regulations. Capital gains tax, or CGT, is a tax levied on the profit made from selling a rental property that has appreciated in value. It's important to note that CGT is only due when a landlord sells a property that has increased in value since the time of purchase, and it's calculated on the profit made through the sale, not on the total sale price. UK resident landlords typically qualify for a CGT allowance, also known as the Annual Exempt Amount, or AEA. This allowance is worth £3,000 per tax year and allows landlords to receive a certain level of gain tax-free. CGT only applies if your total gains for the tax year exceed this yearly exemption limit. The CGT rates for landlords are split into two bands, depending on your overall income tax rate. Basic rate taxpayers pay 18% CGT, while higher rate taxpayers pay 24%. If your capital gain pushes your total income into a higher tax bracket, you may have to pay CGT at both rates. Let's look at an example. Suppose a landlord purchases a property for £300,000 and later sells it for £375,000. The increase in value of £75,000 is the amount considered for CGT. After subtracting the tax-free allowance of £3,000, the remaining taxable profit would be £72,000. Assuming the landlord's total income puts them in the higher rate tax bracket, they would pay 24% CGT on this amount, resulting in a tax bill of £17,280. It's worth noting that HMRC can change CGT rates in the future. Landlords can potentially reduce their CGT bill through various exemptions and reliefs. These include multiple property ownership, where the tax-free allowance is multiplied by the number of owners, and private residence relief for landlords who have personally occupied the property at some point. Property improvement expenses and transaction fees can also be deducted from the taxable gain, provided they haven't been claimed on annual tax returns. Non-resident landlords are generally subject to CGT on UK property sales, but specific rules apply to their situation. For UK residents, the disposal of residential properties must be reported, and CGT paid to HMRC within 60 days of the sale. Non-UK residents must report the disposal of all properties within the same timeframe. It's worth noting that landlords who have set up rental properties in a limited company are subject to corporation tax instead of CGT, with different rates and thresholds applying. Given the complexities of capital gains tax, seeking guidance from a qualified accountant before selling, transferring or disposing of a property can lead to substantial tax benefits. You can find out more about tax for landlords, tax rebates and tax calculators at www.taxrebateservices.co.uk. The content used in this video is intended for educational and informational purposes only and does not constitute advice. We recommend that you do your own research on each subject and take advice from HMRC or a professional tax advisor.